Okay, let's take a look at Chapter 11, Current Liabilities. We've worked our way through a good portion of the balance sheet. We looked at cash, inventory, AR, long-term assets, and now we're on to the liability section. Current liabilities. Current liabilities are debts and obligations paid with current assets. I'm not going to write as I go. I want to kind of try and fit this all into one video rather than write as I go this time. Paid with debts and obligations paid with current assets or possibly rolled over to new current liabilities. But the important part is that it's within a year. That's what makes them current. They're things that should be paid off within a year. Examples, of course, accounts payable, notes payable that are due in less than a year. Unearned revenue. Unearned revenue is an obligation. We'll talk about that a little bit more. Accrued liabilities, things that, remember, an accrued liability means we've recorded the expense before the cash happens, meaning we accrue taxes and pay it later. We accrue salaries and wages, so we will have a wage expense, but we may not pay it until later. Same with interest expense. So that's what it means by accrued liabilities. And those would be current liabilities. So let's kind of go through this list of current liabilities. It's kind of a grab bag of a bunch of small things with kind of one major topic at the end, which is payroll. So let's take a look at our first topic, which is notes payable. Well, we've encountered this before, both from the notes receivable side and the notes payable side. Notes payable means we're taking out a loan. We're receiving cash and going to pay it back later with interest. So let's take a look at a short-term loan. $10,000, 12%, 6 months, September 1st to March 1st. Now, the journal entry when we take it out is we receive cash and we record a current liability, a note payable for $10,000. What is the total interest? Remember, the 12% is the annual rate. That's how much we would pay in the year. So if the loan is for less or more than a year, we'd have to figure it out based upon the annual rate. So 10,000 times 12, well, that's going to be $1,200 times half a year, 6 months, 6 out of 12 months. So 10,000 times 12% would be $1,200 times half is 600. So that's the total interest expense that we're going to record. But of course, it gets recorded over 2 periods because part of that interest expense is going to occur between September 1st and December 31st, and part of that interest expense is going to occur between the next January 1st and March 1st when we pay it. So let's look at the adjusting entry at the end of the year. 12/31, the interest expense is $400 and the interest payable. And of course, what are we looking at this for? Because we have a payable, we have a current liability. So we have, how much is it? Well, think about it. From September 1st to December 31st is all of September, all of October, all of November, all of December. Don't get tricked into thinking, oh, September is month 9, December is month 12, 12 minus 9 is 3. Remember, there's a whole month embedded in there. So that is 4 months, 4 out of 12 months. So of that $600, 400 is going to be recorded as an expense in this accounting period. And then of course, 200 is going to be recorded as an expense in the following period. Now, the point of interest that we're following here is not only is the note payable a current liability, so is this interest payable. So we pay off the note payable next year. We record the interest expense between January 1st and March 1st. We also pay off the payable from the prior year. That gets carried over. And the cash is going to be repaying the $10,000 plus the $600 worth of interest. We've covered this several times before, so that shouldn't be too unknown to you. Sales tax payable. So this is also another fairly straightforward thing. Sales tax, let's say you had a sale of $1,000 and there's 8% sales tax. Remember, the company as the retailer is collecting on behalf of the state. We don't get to keep that money. We just collect it and then remit it to the state. So here, cash, the sales revenue was $1,000. Of that $1,000, we are going to add on another $80 for the sales tax. We're going to collect from the customer $1,080. And then, of course, this being the payable, that's the current liability. When we pay it off, it would be debit the sales tax payable, credit credit cash when we give that. So we would just end up with $1,000. Now, the questions in the homework in the textbook are going to look a little differently. They may ask the questions in a slightly indirect way. They may say, what if the total receipt said $864 and you knew it was 8% sales tax? The question might ask, well, how much was the sales revenue? Well, you may not know exactly how to approach that, but remember, if we did 1,000 times 1.08 to get to the 1080, well, we can back figure that by dividing by 1 plus the sales tax to get what this is the sale, and then therefore the 64 would be the tax. So just remember, whenever the question is asking you what's the sale or what's the tax based upon the total number, and they don't give you a breakdown, you divide by 1 point, whatever the sales tax is. Another, as we continue on through the list, unearned revenue. We don't really have much in the way of calculation. This is more just knowledge. Magazine subscriptions, game pre-orders, airline tickets, anything that we receive the cash before we provide the goods or perform the services. Football game tickets. So what does that mean? Well, if a customer has given us cash, they've done their half of the transaction. If we haven't done our half, provided the magazine, provided the game, flown them somewhere, done the football game, that means we're obligated to provide goods and services. So therefore, if we're obligated, that's an obligation. And that's why unearned revenue is a liability. It's not a cash liability. We don't owe someone money. We owe them goods or services. Current maturities of long-term debt, a lot of our consumer loans are this way, but not necessarily a lot of corporate loans. A lot of consumer loans are where, you take out a loan and you're being required to pay it back every month plus a portion of the interest. So car loans, mortgages, student debt, I'm sure most of us have at least one of those, if not all of them, or at least for me. Most is classified as as a long-term liability, but the portion that is due next year is a current liability. It's important to recognize we don't actually write a journal entry to separate out what's the short-term and what's the long-term. It's all included in long-term debt, or it's all included in one account, whatever the debt account is. We just keep track of the maturity date so that we can, when we report it in the financial statement, that we can separate it out quickly or correctly. Here is a new concept you probably haven't heard yet in accounting, and that is contingent liability. That is a situation that it's already existing, we just don't know the outcome. And the outcome could be potentially bad at least for the company, in that the company may have to pay out some money. So the most common one is like lawsuits. And of course, we don't know the outcome yet, and the outcome is depending upon some sort of future event. But remember, for it to be a contingent liability, it has to be an existing situation. It can't be some made up potential future thing. No, it has to be something that's sort of existing right now. We just don't know the outcome of it. Therefore, we're kind of on the hook. If we can figure out, do we actually know enough to be able to record something about it, then we should. And so therefore the rest of this is, do we know enough about the liability? So contingent just means it's dependent upon a future event. So things like lawsuits, insurance claims on natural disasters, a tax dispute, a recall, you've recalled something and you don't know how much it's going to hit you in the wallet. So are you required to record a liability and these are kind of broad general terms. These are actually the technical terms we use in accounting. They're that, I guess, sort of subjective. If the quote unquote likelihood is remote, the accountant is not required to take any action. If the likelihood is possible, then we are required to make mention of this contingent liability in the footnotes. If the likelihood is probable, and you notice we have two different types of probable. So what I'm saying here is probable, but we don't know how much money, it still just goes in the footnotes. Only when it's probable and estimable, able to be estimated, do we actually record a liability. And so those are sort of few and far between. most of the time, if we've got, especially for like a lawsuit, we don't want to inform the other side of the lawsuit that, yes, we think we're going to lose, and B, we think we're going to lose by this much. But there are certain situations where everyone knows, like, for example, an oil spill or something. Everyone knows you're at fault and something's going to come about it. So in order to sort of, state the obvious, you might want to go ahead and record a liability, a contingent liability. There is one sort of common contingent liability, though, and that is called a warranty. In other words, when you issue a warranty for a product that you sell, you are guessing that there's going to be a certain amount of this product that's going to be coming back to be fixed. Otherwise, you wouldn't be using a warranty to sell this product in any case. So warranty is a type of contingent liability. Therefore, is it probable? Yes. You probably have some good facts and figures from previous years or previous accounting periods about how many of these have come back for repair or exchange. And you know how much it costs you to either replace or repair these items. So you can estimate the percentage. So it's probable that's coming back, or at least a percentage, and you know how much it's going to be. Now, the reason that we go through the process of recording a contingent liability is we want to record the expense in the same period as the sale. That's the main reason that we go through a warranty sort of action. So what are the two actions? Well, we've done this before, like with other estimations, like returns, sale returns and allowances. We did that. We also did it for allowance for doubtful accounts. Anyway, there's always two parts of this. There's an estimation phase, and then there's an actual occurrence phase. So here, when we estimate the warranty, I'm going to use the example from the book that let's say there's 10,000 washer and dryers, $600 per piece. We actually don't use that information. It's a 1-year warranty, 5% defect rate. Sometimes they call it a defect rate. Sometimes they call it a warranty rate. That means how many, even if, there may be, because sometimes there's a higher defect rate, but not as many people actually make a warranty claim. So a lot of times we kind of use one or the other, defect or warranty rate. And let's say in the past, we realized that when they bring in these washer and dryers, it takes us on average $80 to repair it. So this is a small enough item to where, this is a large enough item that we would not necessarily just give them a new one. But there are a lot of warranties to where when people say, oh, mine's not right, mine's broken, we would, instead of having a repair price, we would just have a replacement price. So our estimation here is, well, if we sold 10,000 in this period and we estimate 5% are going to be returned, well, that means we believe that there are going to be 500 warranty claims. And so if there are 500 warranty claims and they're $80 a piece, we're estimating that it's going to cost us $40,000 in repair expenses in the future. Now, notice that hasn't happened. We haven't actually spent that money. We're just estimating that in the future. But because we sold 10,000 washers and dryers this year, we believe in the future we're going to spend $40,000, but we want to associate this $40,000 expense with these washer and dryers because it's these washers and dryers that's going to cause us to spend money on repairs. So we want to hit this revenue, whatever the revenue is, $600 times this, so, $6 million. We want to hit that revenue with this expense because it's part of it. And what do? Well, since it hasn't happened yet, we set up a liability. The liability is saying, okay, we've taken the expense hit in the same period, and now we're waiting for the warranty claims to trickle in. Now, we could have estimated completely right at 500. It could be more or less, but whatever we do, we've set up our tracking of how many claims are going to actually come in. This is our estimate, and then we're going to figure out how many come in. So just realize that when I go through this estimation part, this warranty expense and the warranty liability, this increases the liability. Remember that this warranty liability is the potential amount of claims that come in. I have set aside $40,000 for potential claims. Now, what happens when an actual claim comes in? let's say in the next year 300 claims come in, and so I had estimated 500, so I overestimated it. So what I do is I had set aside 40,000 to cover future claims. There were actually only 24,000, meaning I still have 16,000 left in my warranty claim estimation bucket. Now, whether the next year I estimate it at 5% again, or maybe I drop it to 4%, or I revise my estimate as I go along, is less important. I mean, it's important, but it doesn't change the numbers that are already in it. These are kind of rolling go forward. You know, we don't go back and change these. We made our estimate here. This was the actuals, and what's left over, we'll make a new estimate, and then we'll kind of keep working forward. So the actual warranties, as you can see, the warranty liability here, this decreases the liability, because remember, the warranty liability is the amount that I set aside for potential claims. When I actually record an actual claim, well, that reduces that amount. And so we either give them a new inventory, or we have repair parts, or whatever the cost is. Okay, so those are the main components of just all the, I don't want to say random, but all the main, I guess, current liabilities. Let's look at the second part here, which is talking about payroll. And it's not a big topic. Obviously, if you go further in accounting and you take personal income tax, we get a lot more in detail in this. But let's talk about some of the generals of payroll. Payroll, salary and wage expenses, and all the liabilities that are associated with it. So first of all, let's just talk big numbers. An employee's gross earnings are their wages, salaries, bonuses, commissions, and overtime. So we might look at a question in the homework or in the quiz or the exam to where, let's say someone worked 42 hours overtime, their regular salary is $10. I'm just choosing numbers that are easy to work with. Hopefully we're not working for, $5, something like that. Hopefully we're getting better salaries than this. But so you work, whoever worked 40 hours at the regular salary. And then, like most places, let's say this person gets time and a half for overtime. So we would split it apart. The 40 hours at the regular salary of $10 is $400. 2 hours of overtime, time and a half, which is 1.5 times this, or $15 or $30. So their total gross earnings would be $430. So what are the other things that go into payroll? Well, as if you've looked at your own pay stub, you notice that there are things that are deducted from your pay stub. So there are some mandatory deductions, and let's take a look at those first. First one is FICA, and I can't remember, federal, I always forget what it is, something Act. It is made up of two parts, Social Security and Medicare. And Social Security is 6.2% of your gross earnings, up to, it changes every year with cost of living, but it's around $133,000, I think, around now. And Medicare, so in other words, after $133,000, don't we all wish we had that problem? You're not going to be charged Social Security anymore, only on the first $133,000. And then Medicare, well, it'll be charged on any amount you make. So, Elon Musk is having to pay 1.45% on his second billion each year. Medicare 1.45%. So together they make up 7.65. So together FICA 7.65. Then you're also required to pay federal and state income tax. Well, obviously we're here in South Dakota, and I just came from Texas. Both of those are no state income tax, which is great. I used to live in Florida, no state income tax. I used to live in Oregon. They have income tax, but they have no sales tax. Just north of us, Washington State had no income tax. So people like to live in Washington, and they would come across the river and buy stuff in Oregon. So they would pay no income tax and come across, and for big items at least, pay no sales tax. Hey, I guess if you can get it, that works okay. There's a lot of voluntary deductions, and they're voluntary in that you don't have to do them, but by this, by a certain point in time, you recognize you need to put in the time, put some money towards these things. So charitable donations, union dues, retirement contributions, that may not seem so voluntary, but it is. Medical programs like your HSA, pension plans, life insurance, those are voluntary reductions. So what is your net pay or your take-home pay? It's your gross earnings minus your deductions. So we looked at how to calculate gross earnings. We looked at these mandatory deductions. So federal and state income tax will be some sort of percentage based upon perhaps your income level, and you'd look it up on a chart or something like that. Now, from the journal entry point of view, what are we looking at? So there are actually two different things we need to look at. When we pay the employees, we have an employee payroll expense. This is paying their salaries. So here we've got a salary and wage expense, which is the total amount that we're going to be paying. That's like their gross earnings. And then we take out the FICA, we take out the federal income tax, the state income tax, any of those other voluntary. I'll just put here voluntary. And what's left over, that's their take-home pay. So their take-home pay plus all these other things that are withheld equals the total pay. And so what do we do with these? We withhold them from the employee and then give them to the state or federal government or other organizations as necessary. So that covers what the employee sees, that's their payroll. But believe it or not, there is another set of expenses that the company has to worry about that is not usually seen or known by the employees. These are the employer payroll taxes, expenses. So there are primarily two things. So even though the employee has to pay FICA, and remember we said together those make up 7.65. In fact, the employer has to match it. So the employer, if the employee is paying 7.65%, whatever they paid, the employer not only remits the employee's part, but adds on a matching amount from the employer. So it ends up being whatever, 15.3% in total that the government, half from the employer and half from the employee. Then there's one other tax. It's called the Federal State Unemployment Tax Act. Federal or the State Unemployment Tax Act. And they're FUTA or SUTA. Now, there's a couple of trade-offs and whatnot, but in general, if we just consider that it's FUTA, how it works is FUTA is 6%, but they will have an offset for every percentage point that you pay to SUTA, to the state. And state usually is at 5.4. So what they're trying to get at is you should be paying 6% between federal and state. So if you're paying all your state at 5.4, then you're paying just 0.6 to federal. But the two of them combined should equal up to 6%. But usually the split is this, 0.6% and 5.4%. And it's only on the first $7,000 of your wages each year. And that goes towards, well, remember when you lose your job and you have some unemployment benefits, unemployment pay, well, this is where it comes from. It comes from this fund that gets paid into by who? By the employer. You notice that there's no FUTA or SUTA in the employee expenses. It's just solely an employer payroll tax expense. So what do they have? Not only are they paying the salary, but on top of the salary, they're paying their own portion of FICA, and they're paying the portion of FUTA and SUTA as an additional payroll tax expense. Okay, that is chapter 11. I will have a video on the final exam up here shortly and be going through the preparation doc and explanation of that for you to be prepared for the exam, final exam. Okay, thank you. Talk to you soon.